In this reading, we'll study the basics of portfolio planning and construction. We'll start out by discussing the portfolio planning process. And as we've said in an earlier reading, this has three steps: the planning step, the execution step, and the feedback. A central document in portfolio planning is the IPS, which is the Investment Policy Statement. The IPS has some major components. In an IPS, we specify how much risk an investor can take, the investor's return objectives, and the various constraints which are faced by the investor. This is an important document which drives the relationship between an investor and the investment manager or the portfolio manager. We'll talk about gathering client information, and this is crucial because in coming up with a portfolio for an investor, obviously the client information needs to be understood, and this client information needs to be considered in the context of capital market expectations. So we have client information and we consider capital market expectations. Capital market expectations basically has to do with our expectations related to the stock market, the bond market, and other markets where we might be making investments. So we need to understand what the future holds for us. And obviously, these are just expectations because we don't know exactly what will happen in the future. But we take expectations related to the capital market, we take information about our clients, and then based on this, we come up with a portfolio. Now, in the context of a portfolio, we have a strategic asset allocation, and then sometimes this strategic asset allocation can be tweaked for tactical reasons, and that is called tactical asset allocation. We'll also talk about the steps towards an actual portfolio, and a central concept here has to do with risk budgeting. In risk budgeting, we will look at the fact that we need to understand the total amount of risk that an investor can take. So a given portfolio should have a maximum amount of risk based on the investor's profile. And then we can allocate this risk across different sources of return. The final part of this reading is about ESG considerations in portfolio planning and construction. And this is becoming increasingly important because many investors are concerned about environmental issues, social issues, and governance issues. This picture might look familiar. We used this in the first reading on portfolio management, where we talked at a high level about the three stages or three steps in portfolio management: planning, execution, and feedback. In this reading, we get a little deeper into the planning step and into the execution step. Let's start with portfolio planning. Portfolio planning can be defined as a program developed in advance of constructing a portfolio that is expected to satisfy the client's investment objectives. This is important. Most of what we will do over the next few slides is to understand how we can define a client's investment objectives. The written document governing this process is the Investment Policy Statement, which is generally called the IPS. It defines a plan for investment success given the client's situation and requirements. The IPS should be reviewed on a regular basis. Every client situation is going to be different, and we need to define the IPS with the client's situation and circumstances in mind. Here are the major components of an IPS. Introduction. This describes the client. Statement of purpose. This section states the purpose of the IPS. Statement of duties and responsibilities. This section details the duties and responsibilities of the client, the custodian of the client's assets, and the investment managers. We need to recognize that at times the client might be different from the custodian. For example, the client might be a 10-year-old child and the custodian might be an uncle of the child. So we need to be clear about the duties and responsibilities of each person. Procedures. This section describes the steps to take to keep the IPS current and the procedures to follow to respond to various contingencies. Investment objectives. This section describes the client's objectives in investing, and here we will talk about return objectives and risk objectives in detail. Investment constraints. This section presents the factors that constrain the client in seeking to achieve the investment objectives. Here we will talk about constraints such as liquidity, time horizon, and so on. Investment guidelines. This section provides information about how policy should be executed and on specific types of assets excluded from investment, if any. If a client does not want to use leverage, then that would be specified in this particular section. Evaluation and review. This section provides guidance on obtaining feedback on investment results. And finally, appendices. This might include the strategic asset allocation, rebalancing policy, and so on. We'll talk about these items in more detail later. Risk objectives are specifications for portfolio risk that reflect the risk tolerance of the client. Every client will have a somewhat different risk tolerance, and it is extremely important that we specify the risk tolerance in the IPS. The overall risk tolerance of a client will depend on his willingness to take risk and the ability to take risk. Note that the client could be an individual investor or an institution. The ability to take risk depends on the wealth of the client, time horizon, expected income, and so on. Note that these items are all fairly objective, so it is relatively easy to determine this aspect, the ability to take risk. The willingness to take risk is a little more subjective because it is based on the client's psychology, and it is also based on the client's situation and circumstances. For example, if a client has just been fired from his job, that will impact his psychology to some extent, which will impact his willingness to take risk. If you see Exhibit 1 in the curriculum, this defines several questions that you can ask your client in order to determine his willingness to take risk. From an exam perspective, as long as you understand this high-level point, that is good enough. Risk tolerance can be expressed qualitatively as high, medium, and low. At times, you might be asked to rate the ability to take risk and willingness to take risk separately. For example, you might have a client who has high ability to take risk, but relatively low willingness to take risk because he is a very cautious sort of person. You then need to put these two together and determine what is the appropriate overall risk tolerance for your client. We can also express risk tolerance in quantitative terms, and this will be done more often for institutional clients. However, recognize that quantitative risk objectives can be expressed either in absolute terms or relative terms. Here is an example of presenting risk objectives in absolute terms. A portfolio should not suffer more than a 5% loss in any 12-month period. By specifying this 5% loss, we are quantifying our risk objective, but this is not very practical because nothing can be guaranteed, so we probably need to make the statement a little more practical, and here is how that might be done. With 95% probability, the portfolio should not lose more than 5% value in any 12-month period. By introducing a probability, we are making the statement more practical. Risk tolerance can also be presented through a relative measure, and here we can say something like the return should be within 4% of the S&P 500 index return. If the S&P 500 index is your client's benchmark and the client wants to get a return that is generally around the same return as what the S&P 500 index is giving, then a risk measure could be presented like this, that the return should not be too far off from the S&P 500, and quantifying that not too far off is done through this 4% figure. Let's look at some examples now. Your client has a portfolio worth 10 million. He cannot handle losing more than 1 million over the next 12 months. Is this an absolute or relative risk objective? And how can this be stated in practical terms? As we've just seen, this is an absolute risk objective because we are saying that the client cannot handle losing more than 1 million. So he doesn't want to face a 10% loss or greater. To make this more practical, we need to specify a probability. So we can say that with 95% probability, we do not want the loss to be more than 10%. Another client specifies a risk objective of achieving returns within 4% of the BSE 100. Is this an absolute or relative risk measure? Based on what we've just talked about, this is a relative risk measure because we are looking at the return relative to the BSE 100. We don't want our returns getting too far off relative to the BSE, and the too far off is defined by the 4%. Identify a measure for quantifying this risk objective. This is not a hugely important item at level 1. This is something that we will see in a lot more detail at later levels, but I will cover it very briefly because it is mentioned in the curriculum. The measure that they are looking for here is called tracking risk or tracking error. The tracking error or tracking risk is the standard deviation of the difference between the portfolio return and the index return. The index in this case is the BSE 100. If that is 2%, in other words, the tracking error is 2%, then 2 times the tracking error here is the sigma, 2 sigma is 4%, which is what the client is looking for in terms of his risk objective. Note that if the distribution of returns is normal and we are 2 sigma on each side, that would mean 95% over here. So a tracking risk of 2% would imply a return within 4% of the index return approximately 95% of the time. If you understood this discussion, that's great. If not, don't worry about it too much because, as I said before, this material will be covered in more detail at levels 2 and 3. Nevertheless, you can go over example 1. Now let's look at risk tolerance through an example, and we'll take a particular client of ours called Jack Callis. Let us come up with some basic information about Jack Callis. Imagine that Jack Callis comes to you for the first meeting. You are going to be his investment advisor, and here is the information that you collect. Jack has a reasonably high salary, owns his own house, has a fairly secure job. Based on this information, which is objective, you can tell that his ability to take risk is relatively high. You also find out that he knows a fair amount about financial markets. He is confident that equity markets will deliver positive returns in the long term. Based on this information, you can determine that generally speaking, his willingness to take risk is also relatively high. When you combine these two factors, it is easy to see that Jack's overall risk tolerance is relatively high. Take a look at example 2 in the curriculum now. Next, we move to the case of Jill Callis, Jack's sister, who is older. Jack was about 30 years old, Jill is 40. Let's interview Jill and then determine her risk tolerance. You interview Jill, and here's what you find out. Her income just about covers her expenses, but she is a consultant and her income is fairly volatile. She makes monthly mortgage payments, so her house has not been paid off yet. She is a single mother and spends money on her children. A significant percentage of the expenditure goes into paying for the education of her children. Her savings are relatively low, but she is reasonably knowledgeable about financial markets and wants to invest in the stock market because she thinks that the stock markets are going to give her the best return. Based on this information, it looks like her ability to take risk is low. But given the fact that she is knowledgeable about financial markets and wants to put more money in the market rather than in a relatively safe bank account, it looks like her willingness to take risk is high. You, as a financial advisor, need to balance these two items and explain to her that given her circumstances and situation, she needs to be a little more cautious in coming up with her portfolio. Overall, perhaps when we take these two into account, her risk tolerance would be somewhere in the low to medium range. Now take a look at example 3. Return objectives. Return objectives can be stated on an absolute or a relative basis. Here is an example of an absolute return objective. Your client wants to achieve a particular return. For example, your client might require or want a return of 9%. This would be a nominal return number. It is also possible that you and your client define a inflation adjusted or real return of, say, 2%. This is an example of a relative return measure where the client is measuring returns against some benchmark. We might say that the return should be 3% greater than 12-month LIBOR, or the return should be roughly the same as the return on the S&P 500 index. Return requirements can be stated before or after fees, but it should be very clear what the fee structure is. Both the client and the investment advisor need to know how the fees will be calculated. The stated risk and return objectives must be compatible. It would not make sense that the risk tolerance is low, but we are seeking a relatively high return. I want you to work through this example and compute the return objective. This should look familiar. These kinds of questions you did in quantitative methods. There are two parts to this question. First, we need to determine how much money the client needs to have in nominal terms. We are told that he will need 300,000 in today's money, and we are given a 2% inflation number, which means that in nominal terms, at the end of 30 years, he'll need 300,000 into 1.02 to the power of 30, which is this number. You could also use the financial calculator functions and put in n is equal to 30, interest rate per year of 2%, present value of 300,000. The payment is 0 over here, and you compute future value. Either way, you will get this number. Then the next part is, what is the return objective? The client is investing 90,000, and at the end of 30 years, he needs this much money. To compute the interest rate, what you can do is have this entered into your calculator as the future value and put in a negative number. Put in n is equal to 30. The payment is equal to 0 because we are assuming that no payments are being made, and you put in present value is equal to 90,000 and compute the interest rate. What you should get is 6.18%. Just to double check, you can then do 90,000 into 1.0618 to the power of 30 and you will get approximately this number. Now do example 4 in the curriculum. This is a simplistic example where we assume that there are no cash flows in the middle. If the client is saving a particular amount of money every period, then you can use a non-zero number for the payment amount. And again, you saw these sorts of questions in the quantitative methods part of the course. We've talked about risk and return objectives. Now we come to investment constraints. There are 5 constraints and we'll go over each of them. Time horizon. This constraint deals with the period during which a portfolio is accumulating before assets need to be withdrawn. If you take the example that we just studied, the portfolio is initially 90,000. This money is being invested for 30 years and then the money will be taken out at the end of 30 years, or the portfolio will be liquidated, and then another portfolio will be created to generate retirement income. For this particular portfolio, the time horizon is long. To understand this concept in a little more detail, I want you to look at example 5 in the curriculum. Next, tax concerns. This deals with the tax status or the tax situation of a client, which must be specified in the IPS. The tax status varies from investor to investor and must be considered when evaluating a portfolio. If in a given jurisdiction there are very high taxes on dividend income, then it makes sense to create a portfolio of stocks that pay relatively low dividends. Liquidity. The liquidity constraint must also be specified in the IPS. This tells us about any constraints or requirements related to withdrawing funds from the portfolio. If you have a portfolio from which the client needs to withdraw some funds to pay for his son's college education after 4 years, then that would be specified under a liquidity requirement. The example that I just gave would be an expected cash outflow. You might have a situation where you know that cash needs to be taken out from the portfolio, but you are not sure exactly how much will be taken out and when it will be taken out. This might be the case of a property and casualty insurance company. There again, even though the liquidity requirement is relatively uncertain or the specific cash flows are uncertain, but overall we would say that the liquidity requirement is relatively high. When liquidity requirements are high, then the portfolio should be invested in relatively liquid securities. Another possible situation is where you know that only a certain amount of money will have to be withdrawn after, say, 5 years. And this would be the example where your client needs to send his child to college. Then the part that is going to be needed for liquid purposes can be put into a separate sub-portfolio. I'll give you another example. Let's say that you know that you have a large tax bill of, say, 100,000 at the end of 6 months. And other than that, you do not foresee any liquidity requirements. It makes sense to put most of your portfolio into assets that will give you a high return in the long run, such as stocks. But this 100,000 should be in relatively safe liquid investments because you know you have a specific liability or a specific bill to pay after 6 months. Clearly, the liquidity requirements need to be specified because they will drive the composition of the overall portfolio. Legal and regulatory requirements. This is fairly straightforward. There will be different laws and regulations in every jurisdiction, and the investment advisor and the client need to understand those laws and how they apply to the portfolio. Unique circumstances. If there are any requirements or constraints that are not identified over here or that are not specified in the risk and return objectives, they have to be specified under unique circumstances. Example 6 talks about ethically conscious or socially responsible investing. If you have a client who does not want to invest in companies that deal with alcohol, tobacco, and firearms, that needs to be specified under unique circumstances, and that particular constraint obviously will impact the sorts of investments that can be made and the sorts of investments that cannot be made. Here I want you to read example 6 from the curriculum.
The IPS may also include a policy regarding responsible investing, which takes into account environmental, social, and governance factors. There are some different ESG approaches which are shown here, and these could be highlighted in the IPS. One is negative screening. This means excluding certain companies or certain sectors on the basis of ESG criteria. Then we have positive screening. This would involve including certain sectors or companies on the basis of ESG criteria. So, for example, if an investor wants to only invest in companies that have a positive impact on the environment, that would be an example of positive screening. Then we have ESG integration. This refers to the practice of including material ESG factors in the investment process. Next is thematic investing. This strategy picks investments based on a theme or a single factor such as energy efficiency or climate change. The next point is related to engagement or active ownership. This strategy involves achieving targeted social or environmental objectives along with measurable financial returns by using shareholder power to influence corporate behavior. And the final point here is impact investing. This refers to investments made with the intention to generate positive, measurable social and environmental impact alongside a financial return. As a general point, these ESG investment approaches can impact the portfolio manager's investment universe and may also require the manager to put in place a process to systematically incorporate ESG factors into the portfolio.
We've covered this to some extent, but as an investment advisor or a portfolio manager, it is important for you to understand your clients. When we talk about understanding a client, this is from many different dimensions. You need to understand the client's family situation. Is he married, not married? What is the spouse's income? How many children? What are the costs related to the children? Will the children be going to college anytime soon? You need to understand the employment situation. What is your client's salary? What are the sources of income? What is the volatility of income? You should probably also know what industry the client is working in. If the client is working in the tech industry, then it actually might make sense to avoid tech stocks, because if this industry does badly, then his job as well as his investments might be in trouble. You need to understand your client's financial situation. Is he well off? Does he have a high amount of savings or not? Because that also will impact his risk tolerance and hence the composition of the portfolio. I now want you to read examples 7 and 8 from the curriculum that illustrate these points.